Hey there, it's Laura. And this video is going to talk about a unique animal in the tax code, and that is the form 1099. Did you know that there are more than 20 different kinds of 1099s? Most clients, most investors only see a handful in their lifetime, so don't worry about it. But if you want to know more about a 1099R, which has to do with retirement accounts, hop on over to the 1099R video where I talk about that. You'll also see other ones like 1099SA if you take money out of an HSA, or if you take money out of a 529 educational account. Of course, there's an individual 1099 for that as well. It's called a 1099Q. If you are a freelancer, you might also be familiar with a 1099 NEC or a 1099 MISC. Those are different kinds of compensation that you might get as a freelancer, and those are reported on different forms. If you're a freelancer, you also might be familiar with the 1099K, which came into everybody's radar a few years ago. That is to report transactions on third-party networks like Venmo or PayPal. There is a higher threshold now. It's if the transactions are above $20,000. So a lot of freelancers aren't going to see that 1099K, but you could. Legislation keeps kind of changing around that. We are not talking about those, not going in depth. We're talking about the forms that you might see if you have an investment account that is taxable. So this is not an IRA, this is not a Roth, it's not a 401k. All of those are retirement accounts. This that I'm talking about today is just an investment account, might be individual, might be joint, but one where all of the transactions that happen in that account within a year are taxable, regardless if you take money out or not. Let's get started with that information. Common forms that you might see from an investment account are going to be a 1099 INT or interest and a 1099 DIV or dividends. Pretty simple to remember. These are generally only used and reported if you have more than $10 to report in interest or dividends. So back in the days when banks weren't paying very much on savings accounts, you might not have received a 1099 INT because there just was maybe a couple of cents of interest. That changes. Once it's over $10, the bank will report that interest on a 1099 INT. But it's not just for banks. You also can make interest in investment accounts. So you could see a 1099 INT from interest that is generated inside of your investment account. Now the 1099 DIV is similar but different. Rather than interest, it's reporting dividends, capital gains and losses that might have occurred over the calendar year in your investment account. And then there's the 1099B, and that's also a little bit different. That is issued whenever selling has occurred in your investment account over the year. So that's reporting capital gains and losses, cost basis, what type of sale it was, so that can flow correctly up into your 1040. Now, when we're talking about flowing into your 1040, that's an important thing to remember is these different kinds of 1099s. They don't necessarily go directly on the 1040. Depends what it is. Sometimes they need to flow through another form or another schedule before it actually gets to your 1040. So if you have this type of investment account, you may consider working with the tax pro. They can help to make sure that everything gets in the right spots and that you are reporting it in the best way possible as far as taking advantage of any tax advantages that might exist within these sales and so forth. Many brokerage companies issue what they call a consolidated 1099, which will be all three of these forms, the INT, the DIV, and the Schedule B, kind of all wrapped up together in a consolidated form that you can use to report on your taxes. But here's the thing on 1099s, guys. They come out a little bit later than your other tax forms, usually about mid-February, and they can even be later than that. Why? Well, mutual fund companies can reclassify or revise the type of income that they report on these forms. So if you have an investment account, you might wait until at least late February just to make sure you're not going to have to file a revised tax return because you get a revised 1099 from a mutual fund company. This is usually not a mistake, it's just a reclassification, and it's something that the companies are allowed to do. Pro tip, if you're expecting 1099s from investments that you have, wait until at least mid-February, probably late February, to do your taxes and report these, honestly, to save you headaches later on down the road. And then there are also K1s. Sometimes, depending on the investment, if it's a certain kind of partnership, for example, or a private company, those companies will report this information on a K1. Those are supposed to be reported in February or March. Mid-March is usually when K1s are expected from companies, but it's not a hard and fast deadline. If you are expecting a K1 from a company, they probably will send you some updates on when you can expect that. Hopefully it's by mid-March. Sometimes, however, if the company itself has extended its tax reporting, that might not be until until September. The tax deadline, if you file an extension, is mid-October. Sometimes if you're expecting a K-1 from an investment, you might be filing an extension as well. So just kind of be aware of that. Again, the companies should be in touch with you regarding the specific forms that they expect to issue and the deadlines. I think the important thing with this potentially confusing area is to be in touch and communicate with either the companies that you have investments with or your broker, if it's through a brokerage platform, so that you can know what to expect as far as which forms and when they might come to you.